Good evening, all. We should be starting in a minute or so. Good evening, all. We are yet to commence the call. We're just waiting for a minute or so. Good evening, everyone. ASK Investment Managers invites you to the ASK Indian Entrepreneur Portfolio quarterly update call with Sumit Jain, who's a Deputy CIO. Just to give you a small brief, Sumit has around 19 years of experience in the Indian equity market. He was actively involved in the conceptualization of the Indian entrepreneur strategy and currently manages the Indian entrepreneur portfolio with an AUM of over $2.5 billion. He also oversees other investment strategies at ASK. He has been instrumental in building the proprietary valuation model at ASK. In past, Sumit has worked with ICICI Prudential Life Insurance and First Global Securities. He is a postgraduate in management from Business University, and he joined ASK in October 2005 and is part of the team since then. Over to Sumit, who would then give an update on ASK Indian portfolio.
Rahul, thank you. Thank you for the introduction. Am I audible?
Yes, Sumit.
Friends, welcome to this update call on Indian Entrepreneur Portfolio. The way I plan to take this up is first talk about very, very high level discussion on global aspects, then taking you through what's happening again at very high level on the Indian economy side. Will not get into very, very minute details there. Then we'll talk about the performance of India Incorporate, because that's very vital. At the end of the day, while markets have been really buoyant, finally it's earnings growth that would drive market over a long period of time. So what are the sectors which are kind of doing well? What are the sectors where there are challenges? After that, we'll take you through what has been the changes that we have brought about in Indian Entrepreneur Portfolio. What is our positioning? And then we'll open this floor to question and answers. So what has been the key event last quarter? I would say one very important aspect that has happened in last 3 months actually has been inclusion of India's inclusion of India's bond into JP Morgan Global Emerging Bond Index. So this is a very vital thing. While the inclusion would start from somewhere around June of next year and will go on till about March the year after. Every month we'll see 1% weightage increase into the index. But what would this lead to is weight of about 10% in the benchmark. At 10% weight, India would be sharing that weight with China, Indonesia, Mexico. This is clearly shows that India would be getting decent amount of money. In fact, the passive flow itself could be about 20 to $25 billion. And we believe this is just the start. It may not remain at JP Morgan Emerging Bond Index Fund. We may see inclusion into other bond indices as well. And what does this do? Over long period of time, this while this may induce some bit of volatility when globally things kind of alter for worse, but at the end of the day, we'll get a decent amount of inflows, and this may have certain implication on the overall interest rate in the country. And when that happens, we may see some impact or some lowering down of cost of capital relative to what India has versus other parts of the world. So that is a structural positive. And while this is a baby step, but what we believe is this has potential to make some impact over next many quarters. Second important aspect when we think about what's happening in the world is also about how yields are playing out in US and in India. While there has been concern that interest rates may remain elevated for a length of time, and there are talks of higher for longer. That may well remain, but our view clearly remains that the drivers of inflation have started to turn. And that essentially would mean that the US 10-year bond may not remain at a very elevated level for a length of time. Peak may be in sight, but obviously it's really difficult to say as to when would we start to turn. But that's only part of the story. Along with what we are seeing in US at the current point in time, we are seeing the gap between US and Indian interest rates, or US 10-year bond and Indian 10-year government bond. Actually, this gap has come down pretty meaningfully. This is virtually at a level that we have seen almost 15 years back. And this essentially would mean, again, relatively lesser gap between Indian cost of borrowing versus other parts of the world. And again, this would have a relatively decent bearing on currency and on cost of capital again. Another interesting aspect that we have seen world over is crude. While from the lows of June 23, around $72, we saw crude inching up to $95. When there was war between Israel, or rather when Israel attacked Hamas, or when there was this geopolitical tension that kind of started to brew out, the expectation was crude actually would inch up. On the contrary, crude is lower from that point onward. In fact, when this tension arose, crude was close to about $84, $85, which is now down to about $81, $82. While the expectation was contrary. And this has bearing on India's overall current account deficit. While small changes may not have significant bearing, but if crude would have risen sharply, we would have seen certain impact on inflation and current account deficit both. So surprisingly, crude is down. And also this is to a certain extent being driven by what the global scenario is as well. Globally, things, while US continues to remain pretty decent in terms of rate of growth, other parts of the world may not be as great. And this has certain implication on many of these underlying commodities. Not only is crude down, but many of the base metals are also down. And which is why we believe that probably inflation is not a significant worry at the current point in time. Now let's look at what's happening in India on inflation front. Core CPI, which is what is a very relevant number, it has actually been trending down from the highs of about 7-8% around a year and a half back. We are now down to about 4.5%. This is something which is a pretty remarkable feat. And while overall CPI may have been erratic, which has been driven more by how vegetable prices have played out, how fuel prices have played out. But core CPI, which is X of food and vegetable, X of food and fuel, has actually been very much under control. Now let me take you through the most vital part, which is how has corporate performances been, because markets at the end of the day are derivative of this very important aspect. And we have just completed Q2. All the companies have pretty recently declared their Q2 performances. And at an aggregate level, while BSE 500, which is bulk of the market cap of the country, revenues there have been virtually flattish, 2% growth. We have seen pretty solid growth at operating profit level and PAT level alike. We believe decent amount of this margin expansion has already come by. From here on, business performance also has to be driven by how revenue growth is playing out. And this is something we are really positive on the economy front. While we have seen some slowdown in revenue growth, interestingly, if you look at margins, at an aggregate level, India Incorporate used to be at about 15.5% margins. Today, this margin is close to about 21%. So they are almost 5.5% higher than what we were at pre-COVID times. This talks about how India Incorporate has performed from a cost control perspective, which is very vital. Now let's look at how each sector has performed. Let's start with IT, which is almost close to about, depending on what is the index one looks at, but close to about 10 to 15% of the index. If you look at IT businesses, they generally Q2 is seasonally strong quarter. Yet we have seen revenue growth actually getting impacted pretty meaningfully. Not only is revenue growth impacted, margins are also on a lower side. In fact, IT is one area where margins today are lower than what they were pre-COVID level. And clearly, IT sector gets impacted by global vagaries. And if you look at our positioning in IT space, we have been at a pretty lower level in terms of how we are positioned from portfolio perspective. We'll closely watch out for this space. Some IT businesses which are very niche, focused on few areas where there are consistent investments that are happening, are the areas where there could be opportunity. But other than that, in general, we do not believe IT sector in specific should grow at a very meaningful rate. We believe that most of the large cap IT businesses over long period of time should compound their revenues close to about high single digit or at best low double digit, and almost similar profit growth. Don't see significantly larger scope of increasing margins there. Now let's look at another area which has actually been a pretty bright area, auto and auto ancillary space. They have done rather very good. In fact, in many areas, whether it is two-wheeler or whether it is PASCAR or M&HCV, many of the product deliveries actually are coming up to age. I mean, in the sense, we kind of manufacture products which are best in class in the world. Product quality in India is really improving. And if we see a scenario where for OEMs, if rural kind of start to stabilize, we will actually start to see better revenue growth as well from what we are at the current point in time. So we are pretty positive on this entire space. Corporate performance here has been pretty decent. Many of the companies actually saw upgrades. So this is one area where I think things will continue to get better. From the margin delivery perspective, even though volumes are not way higher as compared to many of these companies versus pre-COVID level, margins are. That talks about how these companies have delivered from a cost control perspective. And we believe many areas where there is still scope to see margin improvement. Now let's look at another area, which is consumption. And this area gets talked about in a very significant manner. We are seeing very interesting scenario, and so-called K-shaped recovery kind of clearly is being visible. Staples, which is one part of the consumption, but just one part. There are multiple other areas within consumption. That is one part that has got impacted. Rural has been suffering, urban also has slowed down. Having said that, what's also is happening in staple business is further deterioration is not being witnessed. So if inflation doesn't remain a problem, we believe there should be improvement on the rural side. Other than that, footwear and some other areas also saw impact. But what has been the bright area in the entire consumption space has been many retail businesses have done well. Quite a few jewelry businesses actually are doing well. Airlines, the way we are seeing travel kind of playing out, not only hospitalities or airlines, this is pocket where we are seeing a lot of improvement. In fact, many of these areas we are seeing while where there is some K-shaped recovery, positive recovery kind of playing out, margins also are higher than what they used to be pre-COVID. But at the current juncture, we should look at consumption space, not necessarily from a quarter to quarter perspective. We should look at this space from 6 months perspective, Q2 and Q3 combined, because this space actually gets impacted significantly when there is a shift in festive. So in the previous year, festive was divided between quarter 2 and quarter 3. This time we are seeing festive more in quarter 3, which is why we actually would see dramatically better number in the quarter 3 that we are undergoing at the current point in time. But right way to look at would be how these businesses are kind of playing out from a festive to festive. Here, what we are seeing is pretty decent. I mean, we have pretty recently we're done with Diwali, and Diwali sales actually have been decent. Online sales have been very solid. Jewelry sales have been decent. So we are kind of pretty hopeful that discretionary will continue to do well. Staples should start to show some improvement. And if you look at two-wheeler sales as well, wherein there is some bit of rural element, this festive retail sales are higher by about 18 to 20%. That's a pretty solid number at that level. So we are pretty positive on how the entire consumption space over next few years will play out. And consumption also is a beneficiary of multiple aspects: India's own demographic profile, higher income level, and aspiration level, significant penetration. So this is one area where we are kind of positioned pretty nicely on. Our positioning is more on the discretionary side, where as income level increases, those businesses would be beneficiary of the entire episode or entire transitioning that we are seeing. One very bright area or one very bright spot actually has been about manufacturing in India. And after a length of time, we believe that this is area where we are seeing activities kind of sustaining. Whether we look at capital goods, whether we look at manufacturing, defense, engineering, construction, not only has revenue growth been pretty decent, we are seeing margin expansions as well. In many cases, margins are now higher than what they were in pre-COVID era. While revenues are what they are, given the fact that we are approaching election, we have seen some bit of slowdown in order intake. Having said that, we believe this is more of a temporary phenomenon. We'll closely watch out for this space. I think there will be a lot of opportunities that will continue to emerge in this arena. Manufacturing in India for the country and for the world is an area where will continue to see a lot of investments taking place. And from portfolio perspective as well, we would continue to focus on offensive defensives, businesses which cater to retail businesses and businesses which show offense wherein there is a decent amount of decent amount of capex oriented or rather infrastructure industrial activity related opportunity. And we'll also focus a lot more on consumable businesses because as we start to see manufacturing starting to do well, a lot of consumables actually will start to see significantly high elevated level of activity. So this is one area where we would see a lot of opportunity, and this is actually backed by how government is also kind of putting up their capex, putting up their investment, putting up their spend. So government has been very aggressive. Decent amount of their spend, of their full year spend, is kind of being done. So to that extent, I believe while 10 lakh crores is the government announced capex for FY24, next year again is going to be a meaningfully higher. Now let's look at another area which again points to how we are seeing divergence in activity where discretionary part, K-shaped recovery is really playing out. Real estate companies, top 8 companies actually have reported pre-sales activity of close to about 23,000 crores. This is very close to what we saw in Q4 of FY23. From YOY, this is up 56%. Pretty solid numbers. And so all these things point to a very interesting aspect. A, macro is all right. People are ready to spend. There is a decent amount of discretionary spending that's happening. And over period, we will continue to see shift from unorganized to organized business. That's a shift that has been taking place and should continue to kind of play out. Now let's look at the banking sector, which while in the marketplace has been an underperformer, but a very interesting trend. So banking actually, the triaca of things, of the triaca, two things continue to do really all right. AUM growth remains pretty decent. If you look at the systemic growth as well, close to about 14 to 15% is something that is being witnessed. And we see no reason to believe that there is going to be material slowdown in the overall systemic credit growth. So this is one aspect I think we'll continue to see. Asset quality has been pretty strong. There may be some things in the armor here and there, but at an aggregate level, asset quality is not a worry. What has not worked in the banking space is necessarily about NIMs. And we have seen some compression of NIMs, and that may see further compression. So this is not something that has been a surprise. This has been envisaged. And we believe some more compression on NIMs is something that we would see. While that was the case in case of banking, and we have been discussing how NBFCs are kind of not impacted as much. In fact, they have actually borne this impact in the last fiscal year, and we'll continue to see NBFCs kind of doing really well even from here on. So overall, if we look at India in corporate performance, we continue to see capex-led growth being kind of sustained. Domestic consumption, while muted, but not kind of deteriorating further. In fact, we anticipate as inflation goes down, we should start to see some bit of improvement there. Financials have been in line. Some export-oriented businesses, whether it is IT that has got impacted. We have also seen how destocking has impacted some bit chemical businesses, some bit pharma intermediate businesses. But again, a very interesting scenario is playing out there. For last 3 to 4 quarters, destocking impacted many of these businesses. But at the current juncture, we may be near to that fag end of the entire destocking phenomenon. So some businesses of ours, whether it is divs or something like that, actually should start to see business kind of stabilizing. While we may see destocking kind of being done, real growth may take some time to kind of really play out for some of these chemical businesses, because global growth continues to remain relatively muted. Pharma businesses actually have reported pretty decent numbers. Um, we have been talking of how US generic cycle has actually seen the worst. In fact, we are seeing that being witnessed in numbers as well. Uh, the margins are actually turning out to be slightly positive as compared to what they used to be in the past. Auto sector, solid margin expansion, pretty bright spot in the overall area. Consumer discretionary volumes actually have shifted more towards quarter 3, which is a festive season. So this is, in a nutshell, how quarterly performance of India in corporate have been. Domestic part doing well, discretionary part doing well. Exports got impacted, whether it is IT or whether it is chemicals or some bit pharma. On the flows front, India has actually seen serious amount of flows. In fact, if one look at 10-year phenomena, India has actually seen higher inflow than any other emerging markets, and by a margin. So I think this is not something one-off. Given the way we are kind of seeing India being a bright spot in the overall arena, rate of growth being distinctly better as compared to what it is for global markets, we believe FII flow is not a concern at all. In fact, we are today seeing not only FII flow being decent, domestic money continues to remain pretty decent. At about 16,000-17,000 crores, and SIP money. This is a very solid number that we are kind of seeing. And this is a structural participation from domestic institution, structural participation from retail investors into the Indian equity markets. Now let's look at how do our portfolio compare versus overall markets versus Nifty or versus BSE 500. If you look at Nifty performance X of OMCs, because OMCs actually have, oil marketing companies have actually skewed the picture. BSE 500 earnings have kind of grown at 25%. Our portfolio earnings have grown at about 33%. But earnings is one thing. What also is more or rather equally vital is, in our case, revenue growth also has been very, very decent. That is a very important aspect, because if companies continue to be more relevant or they increase their relevance in the marketplace, their longevity kind of gets significantly better. So to that extent, we are pretty happy with how our portfolio companies' performances have shaped up for most of the companies. Some bits have disappointed, but by and large, results have not been a disappointing one. While this has been about this quarter, year as a whole, we don't see any letdown in the rate at which our businesses are expected to report in terms of profit. For FY24, we anticipate 25% plus 27, 28, FY24 and 25. In fact, next year, we expect meaningful difference in our profit growth versus what it is going to be for Nifty 50. So what are the actions that we have taken in the last quarter? I would say 3 major actions, or not necessarily last quarter, but over last 5-6 months. 3 major actions. First is we have incorporated Dr. Reddys into the portfolio. We have incorporated Interglobe Aviation and GSW Infrastructure. Let me take you very briefly as to what do we envisage in each of these businesses. As we discussed, Dr. Reddys is a play not only on US generic cycle, which we believe worst is behind. Price erosion has already started to recede, and Dr. Reddy's remains a pretty dominant play on that part of the market. But what we believe is there is a significant scope of how they execute their business in markets beyond US, whether it is India or many other emerging markets. The kind of R&D work that they have done, they have huge scope to replicate that R&D or to use that R&D in many other parts of the world. What would that lead to is not only decent revenue growth, but more than that, the efficient utilization of that R&D should lead to profit growth being higher than revenue. They continue to invest into R&D, and there is no letdown there, right? So not only it is fit for future when we say that they continue to invest in R&D, but even from a shorter term perspective, their business performance continues to remain very solid. In fact, over last 10 years, over last 8 years, where US generic cycle was in a bad phase, they have made sure that their balance sheet actually sees significant improvement. They have cash, net cash to the tune of close to about 4,500 crores. Not only is their balance sheet pretty clean, which gives them a weapon to invest or weapon to kind of do some inorganic acquisition as well. But over period, they have made sure that the growth that they have shown is backed by decent capital efficiency. So their ROC we anticipate, which already is at a pretty decent level, we anticipate it to cross 25% plus. Now let me take you through very interesting company, which is Indigo Aviation. And the way India has embarked on a journey of improving infrastructure. We used to have almost close to about 70 airports 10 years back. Today we have about 140, and next 7-8 years this number should be 200 plus. So clearly we are building infrastructure. We have people who value time, who kind of want to travel. There is a travel activity that has increased for business purpose, travel activity that has increased for leisure purpose. So overall macro is in place. But apart from macro, what is also happening is the ability to increase supply actually is limited. Globally, there are about 25,000 aircrafts which kind of are flying. On an average, 1,000 aircrafts should get replaced every year. Virtually, there are just two players, whether it is Airbus or Boeing, who can supply these aircrafts. And cumulatively, their ability to supply more than 1,000 aircrafts, at least for some time, is pretty limited. So world may not see sharp increase in airlines or aircrafts globally. So those players who has that muscle, who can kind of give large orders, stands a reasonably better chance to increase their supply. So Indigo is one player who actually would be beneficiary of that. And when we look at this company, what gives us a lot more confidence is if we analyze this company over 10-year time frame, when crude oil in INR terms has gone up 3 times. Contribution profit, when I say contribution, revenue minus cost of fuel, because fuel is a pretty decent component, pretty decent cost for this company. That has still gone up. So clearly showing that the ability of this company to kind of increase or improve their unit economics is far higher, which gives us confidence that this is a pretty decent, I would say many times people think about aviation as a more tactical one. We believe structurally things are kind of altering here. We have also kind of incorporated GSW Infrastructure into our portfolio. And the kind of manufacturing activity that we see, manufacturing in India for the world, for the country, if that were to kind of increase pretty meaningfully, port businesses ought to do well. And this is kind of second largest port business. It's a strong proxy to the infrastructure opportunity. And generally, we would see infrastructure businesses to be not very highly capital efficient because those are capex intensive businesses. But this is slightly different. this company still has 20% ROC, pretty decent. And this 20% ROC is roughly on 50% utilization. So as utilization kind of get better, there is a scope of ROC improvement from here on as well. So this company is a beneficiary of overall infrastructure opportunity, and plus a very solid parentage who themselves are kind of investing into steel capacity, paint, cement, which itself will give them very large captive business. So pretty decent growth over next few years is what we think that this company should report. Now, these were the inclusion. How does the portfolio positioning look like at the current point in time? We over last 7-8 months have increased our exposure towards healthcare businesses. We have increased our exposure towards automobile, some infrastructure activity. Right? So this is some change that has been brought about in the portfolio. In general, finance continues to remain at about 27 to 30% range. Consumption, while at an optical level, may look at 27%, but this is because airline as an exposure has been brought about. Yeah, we continue to remain biased towards manufacturing, continue to remain biased towards consumption, finance. What are the areas where we are underweight? We are underweight or relatively lower exposure. We continue to remain towards IT services and many of these global commodities, which get too much impacted by how things play out globally. Our portfolios continues to remain very solid on key investment principles of what are those? We believe it's the cash flow. While investment cycles at times may be different, but over a long period of time, we are fairly confident that it's the growth of cash flows, sustainable ability of businesses to deliver earnings growth and thereby cash flow growth is what would define value creation over a long period of time. And that is where our portfolios are perceptibly different. While we may not see translation of that in the numbers at the current point in time, but it's only a matter of time is what we believe. If one looks at PE ratio, we would be at an average PE of what we used to be in the roughly over last 6-7 years. But growth rate continues to remain very solid. ROC continues to remain. In fact, ROC of around 40% is something which is perceptibly better as compared to what it is for the markets as a whole. Markets would be closer to about anywhere between 15 to 17%. So hugely superior on capital efficiency, and as we just discussed on earnings front, we are way better. Now let me take you through how has the performance been. Calendar year 22 we discussed was not a great year for us. Calendar year 23 we are in line with what the benchmark is. And given some moderation in valuation for our part of the market, we believe this is the time where these high quality businesses, where growth opportunity is secular, and our participation into manufacturing, again, even within manufacturing, we have focused on opportunities which are really secular. Participation into pharma spaces, where we believe we are seeing turns. We believe the superior value proposition exists in the portfolio at the current point in time. Yeah. So I'm open to questions.
Thank you, Sumit. Good evening, all. We request you to kindly type in your questions in the Q&A section. Sumit, to a few questions to start with. Is the entrepreneur-focused thesis challenged at this point of time?
So see, this is a phenomena that we saw, especially in last calendar year, where entrepreneurs as a pack actually underperformed pretty meaningfully many of the other ownership patterns, right? Whether it is PSUs, whether it is multinational companies or professionally driven firms. But when we think about opportunities, it's the entrepreneurs, right? Because world is not static. You need to be agile. You need to be adapting to how technologies are changing globally. The ability of many of these entrepreneurs to really be agile, really adapt to the changing one, really focus on these new age opportunities is really high. Right? At times when stock markets participants ownership in few of the ownership pattern is low, we see huge divergences. But that is a phenomena that we saw in last calendar year. If you look at this calendar year, entrepreneur as a pack actually is coming back. Right? So I would think that this was more of a blip, and history says us. We have seen, I mean, it's not a new one that entrepreneur as a pack has done far better. I mean, if you study US markets as well, it's no different. While over period, it may get into more professionally driven firm, but it's the entrepreneurial culture, it's entrepreneurial aggression, the thought process actually which change, which alters the course of the company. And we are pretty confident that while calendar year 22 may have been different, but that's a blip. In fact, when we see such kind of blips, those are times that the focus has to be a lot more on that part of the market. And interestingly, it's not only about execution. While execution is vital, agility is vital. Very interestingly, we are seeing huge amount of kind of improvement in their corporate governance principles as well. Many of these entrepreneurs are a lot more open. And with that, their ability to command valuations as well, because corporate governance plays a very important role. So for us, pie also keeps getting better with that.
Thank you, Sumit. Investors are still showing a lot of interest in the small and mid cap part of the business, and that's where we are seeing the inflows coming in. What is your view in this segment, and how is our IEP portfolio positioned?
So see, fundamentally, I mean, we have not seen the kind of divergence in performance between large cap, mid cap, small cap indices as what we have seen in last, or rather in this calendar year, right? These are not, or these are rare phenomena. While we have seen huge amount of returns in that part of the market, I would think this has actually been backed by significant amount of flows that is coming into that part of the market as well. I believe returns from here on will not be very broad-based. Only those businesses which actually kind of deliver onto the performance will actually, business performance will actually sustain onto the multiples that we are seeing. So it has to be very discrete now, right? So we will actually see huge divergence. That's one. When we look at corporate performances as well, between large businesses or mid-size and small-size businesses, we have seen a slowdown in mid and small cap businesses as well. So this slowdown in growth is not limited to large cap, but this slowdown in revenue growth has been witnessed in small and mid-sized businesses as well. And similarly, profits have also been amplified. Large businesses have seen relatively decent margin expansion, and so have mid and small businesses as well. Historically, we have seen the, I would say, overall increase in margins when commodities go down. To a certain extent, mid and small size businesses actually show relatively higher margin expansion, but over period, this gets passed on, right? Because at the end of the day, if you don't have a pricing power, it can't be something that can be retained, right? So to that extent, we will have to focus on businesses where if one needs to look at compounding or value creation from a longer term perspective, we need to focus on businesses where there is execution prowess, where there is pricing power, where managements have ability to maintain, improve capital efficiency, and capital efficiency itself is a function of margins and asset turns. So to that extent, I would think returns from here on is not going to be something which is very broad based. It will be very, very divergent.
Thank you, Sumit. With the quarterly results behind us, we have seen a strong jump in profits. At the same time, revenues were muted. What are your thoughts on the same? And do we see better top line along with profits in the H2?
See, overall rate of growth in profits in H2 for India in corporate will be lower, and that's more because, see, funnily we look at YOY numbers, right? At the current juncture, what's also is happening is these YOY comparisons are not turning out to be very meaningful, because base itself may have been disturbed, right? And also festives have moved on, right? Having said that, I believe rate of growth will be lower as compared to what we saw in H1 of this fiscal year, rate of growth in profits. But clearly, this slowdown in revenue growth is also a function of past lower commodity prices. This is also playing onto revenue growth. Once this comes into base, we'll start to see revenue growth getting better. In fact, if India continues to grow at about 6-7% rate, we see no reason to believe why would revenue growth be not double digit.
Thank you, Sumit. Which sectors, oblique stocks, do you believe can create alpha to cover up the underperformance of calendar year 22?
So see, fundamentally, we would do things which we believe are more structured. We believe which will benefit our portfolios from a long-term perspective. We'll not do things which are really tactical in nature. We believe there exists huge opportunity. I mean, as I was saying, auto is one area where there is opportunity. Things are altering. Right? Similarly, consumption, discretionary part of the consumption where we have relatively high weightage. That part of the market should kind of continue to do really well. So auto, consumer discretionary, pharma are areas where I believe opportunity exists. Not to forget, very large opportunity in terms of manufacturing in India. See, what happens is services ecosystem doesn't take too much of a time to really fructify. It kind of gets into a cycle relatively faster. Manufacturing requires some time. So when manufacturing turns, this is a very long period cycle that we would see. We have played through quasi manufacturing opportunities. For example, we have APL Apollo in our portfolio. If we see a lot more infrastructure activity kind of coming up, a lot more airports coming up, a lot more bridges coming up, right? There is going to be significantly higher demand for structural pipes, right? And that increases opportunity for the company. So these are areas where we continue to focus on. We believe these are areas that should do significantly better in the marketplace.
Thank you, Sumit. This financial year, we have seen a lot of action in the portfolio from the likes of Dr. Reddys, Interglobe Aviation, JSW Infra, now TVS Motors and KEI Industries. What's the thought process regarding these changes that we've done? Are we going to continue to see more changes? And if so, we are now able to see about 27 names. What number of stocks would you be comfortable in holding in the portfolio in the long run?
So see, while there has been some changes in the portfolio, this is because we see in many cases, future being dramatically different as compared to what we saw in the past, right? As we discussed, Dr. Reddys, how we see things being different. We talked about, in case of aviation, how it's turning out to be a very concentrated markets and ability of other players to really expand. Whether even balance sheet doesn't permit many of these entities to really expand their fleet sizes, right? So we will continue to evaluate businesses where we see change, where we see businesses being kind of altering dramatically better. So that's a real-time thing that we'll keep doing. We will look to incorporate relatively higher exposure towards manufacturing, and over period as businesses also evolve, we'll see a lot more opportunities coming up. I think this cycle is going to be different as compared to any other cycle that we've seen in the past on the manufacturing side. We are not seeing the megalomaniac investments that we saw in the last cycle. In the last cycle, we used to see significantly larger $5 billion investments by a single entity, $2 billion investments. This time, we may see more efficiency-led capex, more capex with related to decarbonization. So those are the opportunities that we'll see. So continuous evaluation is part of the game. With respect to number of names into the portfolio, I believe we should be between 25-30 names into the portfolio. We don't believe in diversifying or rather having too small a position into the portfolio. There has to be certain minimum size, certain level of exposure of any stock into the portfolio. That's the way I think about number of stocks.
Thank you, Sumit.
In fact, I believe from our perspective, if you look at it, we have always focused on relatively higher concentration. And this concentration actually can cut both ways. If those businesses don't perform while business performances are there, but if they don't perform in marketplace for some time, you see that impact, right? But when few of these businesses kind of just catch up with how they are really performing into the marketplace, the ability to show the performance also alters pretty quickly, right? So, which is why that has been our style. We believe in right mix of concentration and diversification. We believe this kind of exposure gives us enough of concentration and diversification.
Thank you, Sumit. Recently, so Bajaj Finance is part of our portfolio. Recently, RBI directed Bajaj Finance to stop disbursement under two segments, which is e-com and Insta EMI card. Your take on Bajaj Finance post that, how much could the impact Bajaj Finance have on these two businesses?
In fact, that was done specifically for Bajaj Finance, but that was not the entire thing. We also saw RBI increasing risk weightage on the unsecured part, right? See, we've seen Bajaj Finance is not a new company. We've seen how at the time of any adversity, whether we saw at the time of demonetization, GST implementation, COVID, right? How many of these businesses, given their agility, given their strength, actually have tended to increase their market share after every disruptions. And when things become harsher, you really see difference between good and bad actually coming out to be lot aggressive. So to that extent, I believe while there can be some impact on their rate of growth at the current point in time in the shorter term, but over longer period of time, in fact, they actually will increase their market share.
Divi's Laboratory is part of our IEP portfolio. We have seen fall in net profit margin and operating profit margin of the company in last 2 quarters. What are your views on Divi's Laboratories?
See, I believe while we have a relatively smaller position, we have trimmed our position a bit as well there, right? To incorporate other exposures. Having said that, I believe YOY comparison may look difficult because in the base, they had a very large exposure towards one COVID-related drug, right? And also we are seeing things kind of bottoming out on the API cycle and custom synthesis. So which is why we will start to see improvement in margins. We will, their new molecules has already started to kind of get into the business, right? So business on custom synthesis side will start to get a lot better. In case of API, worst is behind for the cycle. It's only matter of time that we start to see a turn there. Having said that, we have moderated our exposure. We'll watch this very closely as to how this change in margins really play out.
Sumit, we have seen in various platforms a WhatsApp message floating that the high quality names have not delivered any return, meaning delivered about 0% returns in the last 18 to 24 months. A few of our names are in our portfolio. Does that mean that the portfolio is relatively cheaper that we are holding them? And when do you believe that the time for high quality, high growth would possibly start, or is it already started?
So see, I agree with you. Our portfolios have not performed with in line with how they have delivered in terms of earnings. Obviously, earnings have continued, but valuations have not. So clearly making them relatively cheaper as compared to what they were in the past. So that goes without saying. But you know, earnings growth is not the entire story. This earnings growth has to be backed by what is the capital efficiency of the portfolio of the business. If this earnings growth is with the very deteriorating capital efficiency, deteriorating ROCE, then this is earnings growth that has been bought, right? This earnings growth that has been bought from future, right? And may not be sustainable. In our case, we have seen ROCE is remaining at a pretty decent level, right? So none of our businesses have actually bought earnings growth from future. There has been some impact on consumer-oriented businesses because rural was impacted. And if rural kind of stabilizes, which we believe, we'll start to see things getting better. And your question on high quality, high growth, see what is it that create value over long period? Right? While high quality, high growth is has always been a relative term. At the end of the day, it's that growth, long period growth in cash flows. We may term that anything, but even those businesses wherein people call them as value stocks, you don't see value in them till the time you see growth in profits, growth in cash flows. Right. So at the end of the day, it's that investment principle that don't alter. Businesses may alter. Till the time we see businesses continuing to perform on growth in cash flows, I think we should be okay. There can be some timing mismatch, but structurally, when there is timing mismatch, those time offer you better risk return, better risk-adjusted returns, and I believe that is where we are.
Thank you, Sumit. The views on Avenue Supermart, it's a stock which is dragging the portfolio performance for long.
So that has belied expectation, I must say. That company actually has got impacted because of relatively higher impact on their non-FMCG sales, and that is where it is more margin accretive. We have reduced our exposure there. We'll continue to closely watch out for as to are we seeing turns there. They have made right changes into their business model, focusing more on the part which is more margin accretive. They have improved onto their e-commerce business. Delivery timelines have actually shrunk. So they are fighting out this battle. Opportunity is large for them, which is why we are giving them slightly higher rope. But if business don't deliver consistently, we'll take corrective actions. Rahul, you are on.
What is the exit strategy specifically for underperforming stocks? What do we look at possibly? What is the time period that we possibly look at an underperforming stock and exit out?
So, see, these are things where we look at whether is company losing on to market share positioning. Because see, there can be changes in macro, right? Industry growth rates itself may be lower at certain points in time. But since we focus on more secular opportunities, over longer term, we would not be questioning unless things alter within that opportunity itself. We would not be questioning as to how will this industry play out. But something like market share is something that we would kind of focus on very closely. And if for a length of time businesses don't perform on their market share positioning, because if you become relatively lesser relevant in the overall schema of things, it becomes difficult to come back. So that is one area where we kind of clearly focus on. And also this is about relative choices. If we find businesses which are dramatically superior as compared to the one that we already own in the portfolio, it makes logical sense to get to kind of either trim or exit out of a position that we already have.
Do we intend to add any stock from the defense sector that seems to be growing at a much faster pace in our portfolio?
I'll not focus on defense in specific, because defense is also part of the entire ecosystem. What we are seeing is manufacturing, and defense is also kind of relatively higher manufacturing in the country. So that's the space that we are focusing in entirely. And when manufacturing does well, you see capital goods businesses doing well, you see consumable businesses doing well, you see staffing businesses doing well, you see logistic businesses doing well. I mean, if you think about our APL Apollo, it's a play on how infrastructure activity takes place. If you see JSW Infrastructure, it's a play on the entire infrastructure logistics opportunity in the country. Right? So, you know, that's the approach that we have taken. If you think about cables businesses, I mean, if defense does well, if railways does well, if roads do well, a lot more cables requirement is there. So, and in many cases, what we are also seeing is, as I alluded to in automobile, that was just one part, but our product quality has actually improved dramatically. So exports are also opening up in many of these cases, right? Cables was never large exports opportunity in the past, but today we are doing, right? I believe two-wheeler space we have bought into TVS. I think their exports, while has been challenged for some reasons with respect to specific geographies, I think that business, that exports part of TVS should also fire up really, really well. So we are seeing, I mean, when we talk to many multinational companies who have manufacturing in different parts of the world, we clearly are seeing heightened interest by many of these multinational companies to shift manufacturing into the country. Think about Walmart. Walmart few years back procured less than 5% of their total this thing from India. Today, that number is 4 or 5 times as compared to what it was at 5 years back. So huge opportunity in the entire manufacturing arena that we are seeing.
Sumit, your comments on the impact of PLI schemes. Have we started to get the share of pie from China as projector, or is there a long haul still continued going forward?
See, I think it's a journey. We clearly are seeing some impact of PLI, but it's too early. At the current juncture, we may have seen only Apple ecosystem kind of coming into the country. What I believe is supply chain dislocation is real. There is going to be, I'll not say at the expense necessarily of China, where in the sense that China will necessarily go down, but incremental growth actually can be catered by many other countries. It's not only India which is in the forefront. We are seeing Vietnam doing well. We are seeing Morocco doing well. We are seeing Mexico doing well. India, this PLI is a good ecosystem to have been provided to increase manufacturing into the country, and I think this is journey as I was talking about, right? So a lot of opportunities there will come up.
Sumit, our portfolio's EPS growth for FY24 is about 27 and FY25 is about 28%. How much do you see this coming in our portfolio returns, or can it create a larger alpha than the EPS growth? Because since the returns in the past years have been muted in nature.
So Rahul, in my investing experience, I've learned markets have their own way of rewarding and punishing businesses. We always can focus on earnings. Value creation do happen over period, but we don't want to be acting kind of saying that now here on we will see consistent translation of this EPS growth into value creation. All I can say is we've seen that in many times in the past that it's only a matter of time. The more it gets delayed, the faster it can be. But how long can that continue? We can't really, neither we want to time that. We want to be prepared. We want to focus on right opportunities. And when I say we want to be prepared for anything with respect to, because see, markets are markets, right? And you can see some unforeseen situation as well. And when unforeseen situation happens, you tend to see businesses which have strength actually performing dramatically better as compared to businesses which are relatively inferior. And at that point in time, you see huge divergence in performances as well, right? Will this unforeseen situation come with warning? It may, it may not, right? We want to be prepared. We want to buy into businesses where there is strength, right? And when they kind of deliver on to returns, they do deliver.
We've been holding Patanjali, and this is a repeated question which comes in. The take on Patanjali at this point of time?
I would say business has performed really well. We have been discussing there are, in a way, two large businesses currently. One is the bread and one is rather cash cow, which is edible oil business, and second is foods business. We are seeing a very interesting scenario in oil ecosystem in the country. While prices have gone down, but the ability to hedge also has been very limited, and which is why edible oil business of Patanjali was into losses this quarter. But this is something that is a one-off. On a sustainable basis, we believe they should do 700-800 crores of EBITDA on an annualized basis. And that's the kind of cash cow that this business will keep delivering. The real story of Patanjali lies in their foods business. And that is where the performance has been rather reassuring. Not only has revenue growth been pretty superior, margins have also been very solid. And if you look at their penetration-led growth, it continues. They have increased their penetration. They have improved their management bandwidth dramatically. So pretty confident as to how this business will play out over next few years. This business has done all right for us from a stock price perspective, and I believe more is yet to come.
Sumit, we noticed that
because at the end of the day, we are investors who would continue to focus on that business strength, business performance, and that is what is kind of reassuring.
Sumit, we noticed that the exposure to the IT sector is much lesser than the benchmark. Any specific reason that we are underpenetrated on this sector?
See, IT sector, we believe will not grow at a very rapid pace. Many of these large size businesses should grow high single digit or at best low double digit. I think there are a lot better opportunities where rate of growth will be high. Many of these businesses also don't get impacted by, IT business get impacted by global vagaries, right? And where the confidence level is relatively lesser. Our confidence level on how India's macro will perform is relatively higher, right? So to that extent, we see opportunities better opportunities in other part of the market. Within IT, we would obviously continue to look for areas where they are unique, where they cater to specific areas and rate of growth can be high.
Sumit, would we be participating in the TCS buyback issue?
We should participate.
Your views on the blockbuster debut of Tata Technologies?
I would say, and you rightly use this word, blockbuster, right? And see, that's a unique business. When I say unique, it caters to the mechanical part of the automobile value chain, and I believe their growth rates will be pretty superior as compared to what they had in the past. From a valuation perspective, I'll be slightly more worried at the current point in time, given where the stock opened up today. But from a business perspective, I think they should do all right. And they have built a strength. They have very solid captive customers as well. Plus the entire ecosystem of Tatas can be used. We believe business is not only decent from a revenue growth perspective, but their capital efficiency is pretty solid. So not only is Tata Tech doing well, the entire ecosystem, whether it is Tata Elxsi, whether it is KPIT, whether it is Cyient, that entire ecosystem actually is performing really well.
What kind of an alpha can an investor look on a 7 to 10 year of investments in IEP as a portfolio?
So see,
over the benchmark.
Yeah. Let me put it like this. If our nominal GDP growth, or if our markets deliver 12 to 14% rate, 12 to 14% returns over a long period of time, we tend to focus on businesses where earnings growth is a lot superior, right? That earnings growth, even if it is of a lesser order, translate to kind of market cap compounding. We should deliver alpha over a long period of time. Can we put a number, whether it is 2%, 4% over a long period of time? Really difficult to pinpoint a number, but clearly we will focus on businesses which are growing faster, not only faster than our nominal GDP growth, but faster than what the overall aggregate earnings growth for India incorporates is going to be, and that should lead us to deliver higher alpha, versus market over a long period of time. And that is something that we have always focused on in terms of our investing style.
Sumit, if Fed starts reducing the interest rates, which is what we have been hearing, how much of it could benefit India and our portfolio?
So see, um, one of the reason for these so-called high PE businesses not doing well could also be attributed to increase in cost of capital. And when cost of capital has a bearing on what the valuation is, and when cost of capital goes down, valuation should alter. But interestingly, when we look at markets globally over last many years, typically what we have seen is um, whenever world has gone into some problem, that is the point in time Fed has reduced interest rates, and which is why markets have not been great either, right? So to that extent, we have to be very mindful of businesses which continue to deliver on to earnings, right? And that is where we will see perceptible difference in terms of stock price performances when such things happen.
Sumit, 2024 is a year of elections in multiple countries, also in India.
Yeah.
Your small bit take on that in terms of what can be the possibilities on a positive and negative side both.
I mean, so this is 0-1, right? My view is we'll see government continuing, right? And we'll continue to see policies being favorable. We'll continue to see continuation of existing activity that we are seeing. But let's say if we don't see a scenario wherein what we are kind of discussing at the current point in time, we'll certainly see a reaction into the marketplace. And it can be rather steeper one as well. But is that a scenario that I am building in? I would. So markets would directly react to that in terms of. So how are we positioned? See, if you look at it, generally we like to buy businesses where regulatory intervention is limited. And to that extent, such scenarios should have a relatively, I'm not saying that we will not get impacted, but I believe we should get relatively lesser impacted as compared to what impact we may see in the marketplace.
Sumit, a question. Where do you see Indian entrepreneur portfolio, the largest PMS this country has, gets positioned among various mutual fund PMS available in the market?
So see, this is a very, very interesting one in the sense, if you look at our part of the market, we have focused on those businesses which have strength, reasonable size, right? While money has come into more, which is mid and small cap businesses. Technically, multi-cap businesses have ability to straddle across different range of market caps. But at the current juncture, what I see is, and that's more at the aggregate index level. You should take my views with certain caveats, because when we discuss things at index level, those are generalizing too much. But at the cost of generalization, I would say mid cap index and small cap index today are trading at a fairly decent premium as compared to what Nifty is. So to that extent, if Nifty earnings continue to perform, we see, or rather large cap businesses, forget about Nifty. If businesses continue to perform, we may not see the divergence that we saw last year, or rather this calendar year, right? So we should see a more normalized. And see, if you were to look at the performance of different indices, and if you would have been sitting in, let's say, just about 8-9 months back, Jan 23 or December 22, you would not have seen significant divergence in returns in large cap, small cap, mid cap indices over long time frames, whether it is 10, 12, 15, 20 years time. So to that extent, I would refrain from really saying mid cap or small cap. I think it's more going to be bottom up ideation rather than a very broad based returns.
Sumit, we have played the EV cycle by investing in Sona BLW, Sona Comstar. Your views on that stock?
No, business continues to perform, right? They continue to get solid order inflows. Their visibility is for next many years. They would have order book to the tune of roughly about 6 times their current revenue. So solid visibility. I believe they should continue to grow pretty decent rate for next many years. They are very solid on, I would say, differential assembly business, forging business, but they are building very solid strength on the electronic side as well, electrical and electron, and that opens up huge opportunity for them. So which is why I believe we should see at least 20%, if not higher, revenue and profit growth both from this company for next many years.
Sumit, how are we trying to play the real estate story in our portfolio? We saw that in one of your slides, you mentioned about the growth in real estate sector. Are we trying to play there?
So see, some of these listed real estate companies have also been beneficiary of shift to organized, right? Also better quality construction, right? So to that extent, overall industry may not have grown at the rate at which we are seeing growth of real estate, right? Companies here. So what does this tell? This clearly says that there is a premiumization that is happening. There is a shift to organized business. So we can either buy into beneficiary of this shift, beneficiary of the entire ecosystem, or if one thinks about it, one can also buy into opportunities where this shift from unorganized to organized can mean a relatively higher growth for a length of time. So we have played it through a quasi real estate names. So for example, Asian Paints, Havels, right? When many of these houses gets delivered, you will start to see demand for consumer durables. You will start to see demand for lighting products, right? When under construction, you will see demand for cable wires. You will see demand for pipes. If you look at Astral pipes that we own, volume growth has been pretty stupendous.
Sumit, any take on the Adani Group? Do we intend to get in any of these names in our portfolios?
So see, I'll not get into what are the actions that we'll take tomorrow. We consistently evaluate managements who have skill set, who have execution capability. I'll not get into specific names that we kind of would kind of incorporate into the portfolio.
We continue to hold Metropolis Healthcare. Your views on the stock?
So that's a very small position for us. Over last 6 months, it has bounced reasonably well. So that holding actually has helped. It's a small position, and at an opportune time, we'll evaluate as to. But I believe the worst of pricing pressure is behind, and no wonder stock has also reacted to that. In fact, we have been discussing when cost of capital goes up, free money would be limited, and when free money is limited, those new age businesses also will have to be a lot more profit focused. And that also has led to a relatively lesser competition, relatively lesser pricing-led competition.
Dear all, any other questions there, please do type in the Q&A session. Sumit, the TVS Motors has been added in our portfolio. This stock has rallied in the last 2 years. Do you still believe that this is where we could possibly see some more action there?
See, the fact that we have bought TVS shows our optimism. Right? See, two-wheeler industry has not seen replacement demand kind of in a manner that we should normally see. This has got postponed. I think that will start to translate into industry growth from here on. This festive season, industry itself has grown 18-20%. That's a pretty solid number. TVS, to our mind, will increase market share. TVS, to our mind, is positioned rightly on the premium side of the market. So domestic part of TVS will do well. Exports, I think, has a scope of positive surprise. Exports is 25% of their volumes today. Exports got impacted because Africa had some dollar currency issues. Economy were also impacted. But I think TVS has gained market share there as well. Right. So we see both the engines now firing. And most of the investments on product development, their products are way superior. They've evolved dramatically. So we see operating leverage also coming in. That should mean that profit growth will actually turn out to be higher than revenue compounding, which itself can be pretty easy.
Sumit, we don't have any questions at this point of time. Thank you all for taking your time out and attending this session. We will continue to keep you posted on the portfolio updates and also the meetings with Sumit Jain. Thank you all. Have a great day and a long weekend.
Thank you all
Bye.
for participating. Thanks a lot.